Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, your number one YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video, we're going to look at the qualities to take into consideration when filtering businesses that perform well from those that don't. If this is the very first video you're watching, we highly advise you to check out the previous videos so that you can have a much better understanding of what we are teaching. If you also found this video very useful to you, please help us out. Don't forget to like this video, subscribe to our channel if you haven't, and click that notification bell so that YouTube gets to notify you every time we release videos. Now without further ado, let's get down to business. So then, starting off with the introduction, before investing in stocks, we all know that it's important to perform analysis on the listed companies in the stock market in order to identify well-performing businesses from the bad ones, and buying shares in the well-performing ones, having confidence that the capital invested is safe and you'll get some amazing returns in the long run. So we all know this. This ain't new to us all. We've already talked about this in previous videos. So then, the Salaam Stock Exchange has over 27 listed companies, and as time passes on, there will be more and more businesses listed in the stock exchange. That's my speculation. Due to better economic results, and more and more businesses are more likely to seek capital through the stock market. It's a speculation, a hunch. So then, therefore, performing analysis in each and every one of the businesses can be tiring as well as time consuming. Like, just imagine sitting down, having to go through each and every single company, and majority of those companies aren't even the best of the best performing companies, or aren't going to provide you amazing returns. So then basically you'll just tire yourself and burn yourself out trying to analyze 27 companies in the stock market right now, while out of those 27 there are like over 3 to 5 companies that perform really well. So then it could be tiring as well as time consuming. Therefore, before performing strong research on such businesses, it is better to filter out the good performing businesses from the bad ones by focusing on some key qualities that are found in well performing stocks, and using these qualities as standards for filtering bad stocks from the good ones. So then, instead of performing such very powerful analysis, there are a few set of characteristics that well-performing businesses tend to have. So then if you use these characteristics as standards of filtration, it can be much easier for you to filter, to weed out the bad performing companies from the good ones, and therefore focusing your research and analysis on the good ones. So then let's check out what these qualities are, or what these characteristics that well-performing businesses tend to have. So then, the first quality being the business should have at least 10 years worth of financial statements published to the public. So then the aim of having access to such info is so that an investor can have a clearer picture of the events that had occurred to the business in the past and the effect financially. By looking at these reports for at least 10 years, an investor can get a better understanding on the ability of that particular business to perform good as well during good and as well as during tough financial times. So then technically, one of the key features or one of the key characteristics of businesses that are listed in the stock exchange is that they have a responsibility of publishing financial statements to the investors. Now, financial statements are basically statements that try to show and they try to elaborate how a business had performed as far as its finances are concerned during that particular year of business. So then this sort of financial statements are very helpful for investors, as it is one of the key features that help investors make decisions as to whether they should invest in this company or leave out this company, or if they should sell shares of this company if they already have existing ownership, or buy more shares if the business is performing well. So then, by having at least 10 years worth of financial statements published to the public, we basically mean that this business should have been in the stock market for at least 10 years. So then, if it's been in the stock market for at least 10 years, that basically means that it has published financial statements for at least those 10 years. Now, why should we have at least 10 years worth of financial statements? Now, from an economic perspective, 10 years is basically more than enough. I mean, within 10 years, within 10 years of operating a business, there could be good financial years, there could be good years where the business performs excellent and provides excellent returns to its shareholders. And within those 10 years, there could be at least, like, there could be depressed times, there could be tough, challenging times when the business might not perform as well as it's expected or as well as it would perform during normal or during thriving times. So then by having at least 10 years worth of financial statements, you get to have access to a 10 years worth of performance. So then you will have a clearer understanding of how a business can perform, because there are high probabilities of there being good thriving times within those 10 years, and there could be high probabilities of there also being challenging times. So then by having a picture, or by having some sort of reference of how the business had been able to perform during both these times, then an investor would have a clearer understanding as to what this business can do during tough times and during good times. So then this basically acts as a background reference, and an investor can use this data, and from this data an investor could be like, okay, so then if this business can still do well during bad times, I believe that if I invest upon this business, due to what I've seen in its financial statements, I believe that this business can continue to thrive just as the same way as it did over the last 10 years. So it could continue to thrive and provide me good returns during tough financial times, and could provide me top-notch results during excellent financial times. So then an investor should look at these financial statements for a period of at least 10 years. So then from 10 years onwards, that's when you get to have a more realistic and a better and a clearer picture of the true ability that a business should have. Now, the following qualities shall be based on the complexity of 10 years. So like basically all the points that we're going to mention thereafter are on the complexity or in the time frame of at least 10 years. So then all these other qualities should be looked at upon for at least 10 financial years. So then the second quality is that businesses should be able to show consistent profits upon its operations. Now, a business showing the availability of profits for over a long period of time indicates that a business has got the ability to earn profits in both good and bad economic times. But then also, availability of profit shows that a business has got the opportunity for growth, as the profits could be reinvested into the business to grow the business's capital, but also the business has got the ability of paying its investors dividends, because payments of such dividends come from the profits made by the business. So then a business that is able to consistently record profits in its financial statements over time basically gives investors confidence in this particular business, that if I were to invest in this business would still be able to operate and provide lump sum profits regardless the economic situation, or regardless the situation that is happening towards the business. So then if this business was able to consistently provide profits, it gives investors more and more confidence that this business even in the future it will continue to do so. So basically, if you've noticed, these two qualities and other upcoming qualities is basically we're trying to refer to what the business has been able to consistently do in the past, and from that consistent performance, investors tend to have more and more confidence that this business, since it's been able to do this consistently in the past for at least over a decade, then I as an investor believe that this business will continue to do so towards the future. And so if I were to invest into such businesses in the long run, then I am sure to attain lots of returns. Basically, according to how the business has been doing, I expect the business to perform like this. So then basically that's why so then these qualities are basically safety standards, or they're there to give investors assurance of the performance or the ability that the business has. So then going back to the second point, a business that shows consistent profits, as I said, will give an investor confidence that this business means business, and this business is there to provide me returns and excellent returns. So then, leaving that reason aside, a business that is able to consistently record profits. Now, profits, there are two main places profits can go. Number one, it could end up in shareholders' pockets as dividends. Number two, the profits could be reinvested to scale up the business. So then in most normal businesses, most well-performing businesses, these profits go two ways. There's some of it that ends up in the investors' pockets as dividends, and there's some of it that is reinvested back into the business's capital so that it can further scale up the business. So then a business that is able to consistently show profits shows or indicates that it is able and it has the ability to pay its investors dividends as well as reinvest in its own operations so that it can further grow. With the third quality being that the business should show nice growth in capital, revenue, and profits. So, a good business is one that achieves progress and development. A good business is one that keeps on evolving, goes better, grows better and better by the day. So then therefore, referring to the previous quality of good businesses, which was a good business is one that is able to make profits after its operations consistently throughout good and bad economic times. Therefore, once such profits are reinvested into the business, the capital of the business is expected to grow over time. Due to such growth, more resources will be deployed in creating more products or services, which then create more revenue, leading to greater possibility of earning more profits, as that is if expenses are kept in control. So then this quality is an after effect of the second quality, which was consistent profits, consistent recording of profits by businesses. So then if a business is able to consistently make profits, an investor should expect that within those 10 years, or at least those 10 years plus worth of analysis, or those 10 years plus worth of filtration, the investor should expect, so then this business keeps on making profits. So then this investor should expect that these profits, as they're reinvested, this investor should also expect to see some growth in the capital of the business. So then, if there is growth in the capital of the business, what does that mean? If there's more capital, more resources will be financed. The business will be able to acquire more resources, acquire more assets. And what are these resources and assets for? Simple. They're there to make more products or services. So then, if a business has more capital, it's more likely to buy itself more resources, acquire itself more resources or assets, of which such resources and assets could what? Could make more quality or more in quantity or both products or services. So then what happens when this occurs? We should expect an increase in revenue. So then we expect to see an increase in revenue over time. As like I told you, a good business is one that keeps on developing, making progress, goes better and better, breaks every new milestone by the day. So then what happens when it makes more sales? We expect a good business to be one that controls its expenses. So then just because there's an increase in revenue, we don't expect to see expenses blow out or just go out of control. No. We want to see these expenses controlled. Why should they be controlled? So that the business can make as much profit as possible from the revenue. So then we expect to also see a growth in profit over time. So then that's basically what this quality means. Moving on to the fourth quality, a business should show a consistent track record in dividend payments. So then, a business with the ability of paying dividends during each year of its operations indicates that it is able to pay its investors during whatsoever situation the business were to go through. That is, so then that's pretty obvious. A business that shows consistent payments in dividends gives the investor a confidence that if this business had been able to pay dividends throughout these times, I am more confident that if I invest in this business, the business will continue doing so. So then, just like I told you, confidence, it gives investors confidence. So then, a good business is also one that shows growth in its dividend payments over time, therefore reflecting progress and development of the business. So then, basically, it's simple. Like I told you, profits are reinvested, capital grows, revenue grows, profit grow. If profits grow, then investors should expect to see a growth in dividend payments. We always said it, like I said before, progress, development, evolution. A business keeps on getting better and better. So then we expect this business to get better in its dividend payments. We expect to see an increase in dividend payments over time. So then, leaving out consistency, that a business has been able to pay its dividends consistently, therefore an investor is like, ooh la la, this business is nice, it can pay out during good and bad times. So then we should also expect to see growth in dividend payments over time. But however, I should warn you from what we've learned in these previous qualities and the next qualities during tough financial times. So then within that 10-year plus broad range of filtration, or during that 10-year plus filtering an investor is trying to do, like I told you, during 10 years, at least 10 years worth of financial analysis, you will expect to see some good times and some bad times. So then, a business, let's just be real here. A business will not always be sunshine and rainbows. That is, you will not always see growth. You will not always see booming profits. You will not always see booming dividends. That's why there are tough financial times right there. So then, during those tough times, a business could still pay out dividends. A business could still make profits. So then it could still make profits, it could still pay dividends. But then, however, during these tough financial times, there could be a slight decrease in profits. There could be less payments in dividends, therefore automatically indicating that there could be a slowdown in growth of capital. There could be a slowdown in growth of revenue. So then, like, growth will decline, will slow down during these tough times. So then, just because I told you that you should expect to see an increase, doesn't mean that when you go through all those 10 years, you see like 2, 3, 4 bad years, and then you're like, oh my God, this business is bad. I'm leaving it alone. No. That's why we use the term over time, like growth in dividend payments over time, growth in capital revenue over time. So then we use this word over time to indicate that, yes, we are aware that within at least these 10 years, there are going to be some bad and bloody times, but then over time, that is, during majority of these years, we expect to see growth. And if you're like, let's say, if you're on year 10, and if you're to look at the profits from year 10, if you're to look at the dividend payments for year 10, if you're to look at the revenue for year 10, and compare it to the first year, like the last 10 years, like year 1, if you're comparing to year 1, then you should see some huge growth. You should see some development right there. You should see that the business isn't where it is not at the same position it was 10 years ago. So then keep in mind that during these 10 years plus worth of research these 10 years plus worth of filtration you're going to go through, I'm just going to give you a heads up that there are going to be some tough times, there are going to be some bloody times right there. So don't panic and don't shrug off a business just because it's had a few years worth of tough times. So then let's move on to the next point. The business should have less liabilities in comparison to its assets, as well as having the ability to pay off its interest payments. So then this point is more debt related. So then a good business should have less liabilities in comparison to its assets. This is to bring about confidence that if a business were to pay off all its debt, that is, if a business were to pay out all its liabilities, it would still have enough assets to effectively run the business. So then, as far as interest payments are concerned, the business should be able to make enough earnings in comparison to its interest payments, so that if the business has to pay these interests, the business has to pay. This ensures that a business has got enough earnings to pay out other expenses and make profits after everything has been paid out. So then, liabilities versus assets. So then a good business is one that has less liabilities in comparison to its assets. We all get it. We all get that for a business to thrive, leaving aside it having to issue shares to raise funds, leaving aside the fact that it should issue bonds to raise funds, a business could simply just the business could simply just walk to a bank and be like, hey bank, I need a loan so I can expand this and this and this and this. And it basically gets a loan. or basically a business has needs like supplies, needs to buy supplies on credit. So then it could just go there and do that long term. So then, anyways, moving back to the main point. Now, a business should have less liabilities in comparison to its assets. Why? This gives an investor confidence that in case this business were to so happen, when a business has less liabilities in comparison to its assets, this just shows that a business has got the ability to pay off all its liabilities. If it decided to pay all its liabilities in one blow, it could simply do that. But then what should be the after effects? An investor should expect to see the after effects, that a business should still have enough assets that are there to run the business. So then we all know that, okay, let's talk about capital. So then we all know that capital that is used by a business, like the capital that a business has, is used to, it is used to acquire resources and assets. So then the capital is used to finance the acquisition of assets. So then this is why we compare assets and liabilities. So then liabilities is also another way, or liabilities is also another method of funding assets. Liabilities can also be used to acquire assets. So then when we compare these assets, we expect to see that a business has been able, so then if a business were to pay out its liabilities, we expect that the business would be forced to liquidate some of its assets. By liquidating, we mean the business should have to sell some of its assets so that it can use the money to pay out the debt. So then, when that happens, we expect to see the after effect. The after effect of a good business should be that, hey, it's paid out all its liabilities, but look, it still has more than enough assets. It still has a good number of assets that are there to run the business. So then a business can keep on running even after selling some of its assets to pay out its debt. So then that's what it means. But then also a business that has less liabilities in comparison to its assets simply gives out the confidence that this business isn't more likely funded more by liabilities, like this business isn't financed more by its liabilities, but rather yet it is financed by a bit of both liabilities and capital. So then it's a two-way thing, and it's not a one thing. It's not just liabilities. So then, leaving that aside, but then also the ability to pay off its interest payments. Now, we all know when it comes to borrowing money from Mr. Bank will obviously tell you to pay that money back with more money on top of it, and that more money on top of it is basically called interest payments. So then, a business, like during its operations, like it's made off its revenues, it's paid down all the expenses related to everything that was used to create that revenue, and then the profits that were there were used to pay down other expenses that are used, other expenses that are incurred in the day-to-day operation of the business, therefore making the bottom line profits. So then, a business should be able to pay off its interest payments and still be able to have more than enough money to finance other, to pay out other expenses, and therefore still have enough profits. So then what this basically means is that a good business is one that doesn't necessarily have killer B interest payments, meaning that its interest expenses don't make up a huge portion of its expenses, or don't eat up a huge chunk of the business's revenue. So then a good business is one that is able to pay out its interest payments, still have more than enough money to pay out all of these other expenses, and make more than enough profits to be reinvested and paid to investors, and etc. And last but not least, the business's share price should be less than its estimated value. So then the value of a business is the price estimated by an investor as a reasonable price to be used in buying shares. This value could vary between investors, but in case an investor were to decide upon the value of the business and the business's share prices are lower than that, then it can be an opportunity to the investor, for he or she is able to buy more shares at discounted prices. So then, anyways, okay, so technically, businesses that are listed in the stock exchange, you want to know how they always get the prices for the businesses. So then the prices are usually determined by the aspects of demand and supply. That is, if more investors want to buy into a company, if more investors want to buy shares of a company than those that want to sell it, this shows that this business has got a higher demand, and that makes prices go up. And however, businesses where more investors want to sell out their shares than those who want to buy shows that this business has got a larger supply than demand, so then that causes share prices to go down. So then, now these share prices that are listed in the stock market aren't exactly very useful as far as estimating or determining the value of a business, since they're more or less controlled by the demand and supply of the stocks, which is caused by the investors themselves. Like, it doesn't make any more logical sense. But then what does make sense, though, is when an investor sits down, reads through the business, understands the business, sees the finances, see how this business works, understand its ability, understand its performance, and therefore be like, from everything I've seen here, I think this business, if I were to buy it, I would be willing to put out this amount of money worth of capital to buy this business. So then, that amount of capital, in per share perspective, is basically the value of a business. So then that value, like I told you, it varies between investors. Different investors could have different opinions on what they perceive the value of a business to be, and that's okay. So then if you have your value right there, you're like, I think this business is worth this amount of money. And if you're to go to the stock exchange and realize that the stock exchange is selling at a price that is lower than the value you've estimated, so then if the stock exchange is selling that particular business for a price that is lower than what you perceived, so then that is basically a bargain. That is basically an opportunity for you, because you get to, so then you realize, you understand the value of the business, and you see that in the stock market, it's sold for less than what you originally perceived it as worth. So then, by buying and taking into opportunity the deduction or that bargain, so then if you buy shares, you get to have more shares than what you originally planned for. So then you get to buy more shares at less prices. So then you get to buy into good businesses at depressed prices. So then that's another quality of a good business. However, the case is if you have understood the value, you get into the stock market and you see that it's sold for a larger price than that value. So then you'd be like, wait, why should I pay out more money? Why would you pay out more money for something that isn't even worth that much amount of money? You know this business is worth this. Why would you pay out more for that particular business? So then basically, why would you buy something at a premium while the business's quality itself isn't worthy for that premium? So then that would basically be like, you're basically investing too much. You basically put so much money down, and well, that isn't an opportunity. That ain't no bargain. So then that's just a suck-up loss, like when it comes to investing. So then a good business is one that its share prices are less than the perceived value of an investor. And don't worry about finding value. We'll figure out how to calculate or how to determine business values in future videos. So then, with that said, everybody, thank you so much for watching this video. We hope, we believe, we expect that this video has been very useful to you all. This video has been an eye-opener to you all. So then, if you've enjoyed watching this video, please leave a like. Please hit that like button. Hit it. If you haven't subscribed, please subscribe. Like, just hit that red button. Like, just hit the red word subscribe. Pop, and then go subscribe, and then click that notification bell so that YouTube can notify you each time we get to upload content. So each time we get to upload videos onto YouTube, you'll be one of the very first viewers to watch it. But then if you're also on other social media platforms, that is Instagram, Facebook, Twitter, you can check us out there in our accounts, Matrix Investing. We upload content on a day-to-day basis. So then if you are on these social media platforms, hey, you could get new content, or you could get new information that is related to investing in capital markets, particularly the one in Tanzania. So then check us out on our social media platforms. But then if you also have a question to ask relating to capital markets, related to investing in shares and bonds in Tanzania, you could DM us. You could just, we're DM away in these social media platforms, so then just leave us a DM and we'll be happy to answer. So then with that said, everybody, thank you so much, and have a great day. Don't forget to subscribe.